Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Monday the 11th of September. Markets reopened today in Hong Kong after a second successive Friday of extreme weather which caused the closure of the Hong Kong Stock Exchange. I have all the latest business and finance news for you. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, India hosted world leaders at the G20 summit in New Delhi over the weekend. Attendees included US President Joe Biden and French President Emmanuel Macron, but not Xi Jinping or Russian President Vladimir Putin, who both skipped the forum of leading nations. Host nation India pulled off a huge surprise by announcing that agreement on a final communique had been reached, despite the geopolitical friction ahead of the gathering. The final declaration surprisingly included a joint statement on the war in Ukraine. G20 leaders denounced the use of force for territorial gain, and the agreement talked about human suffering in Ukraine, but stopped short of directly criticising Russia. The Ukrainian government said the statement was nothing to be proud of. The US, India and Gulf countries have announced a historic new railways and port corridor to link the regions. The corridor aims at linking countries in the Middle East by rail and connecting them to India by port. By reducing shipping time, costs and fuel consumption, this initiative would greatly enhance the transportation of energy resources and trade from the Gulf countries to Europe. China's deflationary pressures eased slightly in August as consumer prices rose and producer price declines moderated. China's consumer prices climbed by 0.1% year-on-year, below economists' forecasts of a 0.2% gain and after a 0.3% drop a month earlier. China's producer price inflation dropped 3% year-on-year in August, matching economists' forecasts and slowing from a 4.4% decline in the prior month. Japan's economy expanded by less than expected in the second quarter. The economy grew 4.8% Q-on-Q on an annualised basis in the 3 months to June, compared to initial estimates for growth of 6%. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Dickie Wong, Head of Research at Kingston Securities. And providing a view from mainland China will be Yanan, the Chairman and CEO of Surfin Group. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks rose slightly on Friday but logged a losing week amid renewed worries that the Federal Reserve may raise rates more than previously expected, as data showed the US economy to be stronger than forecast. The S&P 500 edged up 0.1% to snap a 3-day losing streak and finish at 4,457. Over the holiday short week, the benchmark index fell 1.3%. That's the first negative week in 3. The Dow added 76 points, or 0.2%, to close at 34,577. The Dow finished the week 0.7% lower. And the Nasdaq Composite eked out a 0.1% gain to settle at 13,762, trimming the decline across the past 4 sessions to 1.9%. The weekly losses were partly due to stock market heavyweight Apple enduring a 2-day sell-off that wiped almost $200 billion from its market capitalization following reports the Chinese government was planning to broaden the ban on iPhone usage. Shares of the tech group edged 0.4% higher on Friday, but were down 6% over the week, leaving the stock 10% lower from its highs in July. The dollar surged to its highest weekly close since December. The US dollar index has risen for 8 straight weeks, ending last week 0.8% higher, in the longest streak of weekly gains since February 2015. And the onshore Chinese yuan, which isn't in the US dollar index, is at its weakest since December 2007, and offshore yuan fell to a record low since its inception in 2010. China's offshore yuan fell for 5 straight days against the dollar for its worst week since February, to close at renminbi 7.36.5. China's onshore yuan, which is traded on the mainland, was at a 16-year low, trading at 7.34 1/3 against the dollar. The Shanghai Composite fell 0.2% to 3,117. It was down 0.5% for the week. And China's iPhone ban sent supplier stocks tumbling. Luxshare Precision Industry slid 2% in Shenzhen, while Apple supplier Foxconn Industrial Internet dropped 0.6% in Shanghai. Battery giant CAT lost 1.6%, and AI server maker Inspur Electronic dropped 3.3%. Markets in Hong Kong will reopen today after being closed on Friday because of the black rainstorm warning. Looks like they're going to open about 1% lower. That's down 190 points at just above 18,000 when trading gets going. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us on this Monday morning Alex Wong, who is director of Alex KY Wong Asset Management. Morning to you, Alex.
Hi, morning, Peter.
And also with us is Dickie Wong, who's head of research at Kingston Securities. Very good morning to you, Dickie.
Good morning, Peter. And Alex, hi.
Okay, let's start with the China markets. If we look at the performance so far, because we're coming up to the end now of the third quarter, about to enter the fourth quarter. So far this year, the Hang Seng down 8%, the Shanghai Composite more or less flat, actually, up about 0.9%. But Alex, not a great performance really, is it, for the start of the year? But how do you think things are looking going forward from here?
I think it would still be going lower, but not at a very fast pace. I think it will gradually edge lower. Catalysts actually are not much. I think people are still worried about the continual depreciation of renminbi, and the policies for the housing market actually would not help much. And the China-US tensions actually would continue to deteriorate, I think, and hurt the sentiment. Because if you look at the development last week, actually, China and US are hurting each other. So people probably would worry about the escalation of this scenario. So I think overall the sentiment will remain bearish, but the pace probably may not be that much be not that fast, because I think there will not be too much cut losses along the way right now, because I think people already exceeded a lot on their positions.
It looks like the slide in the renminbi, which is really linked, isn't it, to the differential between the US Treasury yields and the Chinese government bond yields. So that gap's widened now to a record high. So presumably the pressure's going to stay on the renminbi from here on.
Yeah, I think this is a problem, because I don't think people expect the renminbi would raise rates. So the only way to narrow the differential would be US to cut rates. So I think this is not easy to happen as well. So I think this differential actually will continue to be bad for the RMB.
What would make you change your mind and become more bullish on the Chinese market in the final quarter?
I think, as I've said, I think we need to see a change in attitude towards the private sector, and I think we need the market to buy in on that change. So right now, I think they are doing some baby steps to show their commitments toward the private sector, but I don't think the market is buying in. So I think we need to see a change in attitudes in that sector, because people probably would know about the SOEs, and actually over the past few months, the strength in SOE actually is not helping the market, and I think people doubt the capability of the management in the long term. So I think we need the private sector to lead the market higher. So this is quite difficult. And for the housing sector, I think it is already done. There's not much to be done, and then I think probably this problem would remain for long term.
Dickie, what are your thoughts? It hasn't been a good year so far, has it, if you're an investor in Chinese stocks, whether you do it here in Hong Kong or directly on the mainland. But what are your thoughts going forward? We're coming up to the last quarter now. How do you feel?
Well, obviously, Hong Kong stock market and also Asia stock market are two of the worst performing markets in the world. And nothing can really stop the momentum right now. I do really agree with Alex. especially when we take a closer look to the renminbi. You can see when renminbi depreciates, the Hong Kong stock market plummets right away. So when we're talking about the longer term tendency of the renminbi, I don't really think that there is any catalyst will boost the renminbi to rebound. So the renminbi obviously will test new low again and again for the rest of the year. This is my personal opinion. And obviously China officials or government, they already did what they can do in the past month. As we all know, Chinese authorities are easing mortgage rules and extending tax refunds for home buyers in mainland. But really nothing to help the momentum and the situation, because most of the people in mainland, they're just lack of confidence in basically everything, not only in the stock market, but also in the property market. And because I don't really see any downside for Federal Reserve. They may continue to hike interest rate in the year end too. So we cannot now conclude that Federal Reserve, they will not hike any interest rate from now on. We cannot simply have this kind of conclusion. So maybe one more 25 basis point or nothing. But obviously, I don't really see any any room for Fed to cut the interest rate. So therefore, you can see the 10 years bond yield from US and China, it's just simply more than 2% right now. So
it's a record, isn't it, that gap?
It's one of the record high, obvious. That's so obvious. So I don't really see any rebound of the renminbi. So therefore, any rebound of the Asia market and also the Hong Kong market will be short-lived. Some of the stimulus from mainland China, including all the, as I've just said, the mortgage rules, and basically PBOC also did whatever they can do. For instance, they already cut the 1 year LPR, the SLF, MLF rates, and also they cut the foreign reserve requirement ratio, and etc. You name it. But you can see the Asian market rebound slightly and then pull back again. Every single time they repeat the same pattern. So in my personal opinion, I think Asian market and I also include the Hong Kong market will continue to underperform everywhere else, including US and
what would make you change?
Europe.
What would make you change your mind, Dickie? What would make you turn more positive on China markets? What would you like to see happen to give you a more positive feeling for the rest of the year?
Well, every cloud has some kind of silver lining. In terms of the valuation, this is one of the things, but valuation always it's not something that very guaranteed. When we talk about the MSCI China and the MSCI US, the valuation clearly, the Chinese market is just only half of its the US valuation at the moment. So we can call Asian market is really cheap. Hong Kong stock market is really cheap now. They're trading at close to one of these historical low valuation. Yes, we can conclude this, but nothing can help the market sentiment, because if you ask me, anything can really help to improve the sentiment in Hong Kong. It's something that the Hong Kong government may do. For instance, have a cut on the several taxes, including trading. Because we are paying very high stamp duty costs for every single trade in Hong Kong. When I buy Hong Kong stock and sell Hong Kong stock, we have to pay 0.26% stamp duty. This is ridiculously high. And second of all, in mainland, obviously Chinese government, as I said, at least they act really fast, much faster than Hong Kong government, but cannot really help the situation. So they need to continue to do all the stimulus, including not only monetary policy, but also fiscal policy. Everything they have to do, because as Alex has just mentioned, the increasing tension between China and U.S. and other countries like including India will not really help the situation, because we can see the tension now intensifying. Even Chinese officials, some of the workers in government, they're not allowing to bring their iPhone back to the office. So this is one of the example.
Alex, I mean, I know you're not that positive on the market overall, but if you look into the market, are there particular sectors or particular areas that do excite you and get your interest?
I think right now people are going all in the oil in China right now, because that is not less affected by the weak RMB. So this is one of the most defensive sector in the market right now, and every people are going into this one. And then I think if you want to buy China, I think you need to buy into the new economy side. So probably the consumer side would still be okay in the long term. So you can go for some value right now in that sector. And for tech, I think we need to see a change in sentiment, because they are cheap and but their power are limited right now. I think people are worried about the long-term restrictions by those regulators. So I think they probably will provide some value, but the momentum actually is not there. So if you want to invest in China, I think either going into the tech or the consumer side in the long term, but the momentum right now is not there. But if you want to buy into something which has momentum, I think oil would be the one.
It sounds like you're being quite defensive and quite cautious at the moment. Is that true the world over? I mean, when you look at other markets as well, are you taking a more defensive sort of posture now and struggling to find value, or?
No, actually, if you go into Japan or US, that is a different story. US has been much more resilient than we expect, because the rise in bond yield actually did not hurt much on the tech sector in the US right now. We are seeing some retreat in Apple on Nvidia last week, and actually many stocks are holding quite well. Say Uber actually is rising last week. So I think that is a different story in the other markets, especially in Japan. We like those anime-related companies, because right now you got more and more hits on Netflix. And just now we got One Piece, and that is very well received in the world. I think Japan actually would be an interesting one to go. And then in US, I think probably people would go into those franchise which may help by the development of AI, but not those hot stocks like MasterCard, Visa Card. Actually, they are very strong right now. Yeah.
And what about India? Is that a market that you're interested in? A lot of focus on India at the moment, isn't there? And particularly because of all the offshoring that's going on, moving supply chains to the country, and it's obviously got good demographics. Is it a market that interests you?
Yeah, but the problem is that we did not get easy access to that market. So basically, we are going into ETF in the US, and one or two counters in the in those India company listed in the US, like one company called Make My Trip, and then that is the Indian version of Trip.com, and actually so it's quite interesting, because you have the success business model example in China, so people probably would like to get into those repeat in India in a few years' time again.
Okay. Dickie, the big story last week was Apple, wasn't it? It had $200 billion wiped off its market capitalization in just a couple of days on this news that China's government agencies have told employees not to use iPhones in the offices, and then reports that this is going to be extended to state-owned companies as well. It looks like Apple is really the latest company that's been taken hostage in the US-China tech war.
Well, it really, nothing can help the situation. And I've just mentioned, as we all know, like the tension between China and US will not be eased basically forever. So in terms of like for single, company, you've just mentioned Apple, and but also Huawei and also SMCIC. They're also under attack as well. So in terms of their share price, but I think Apple will definitely survive. But obviously, people are looking at their new iPhone and thinking that any really significant change on the new iPhone, should I buy one? This has remained one of the key question of most of the iPhone user right now.
Should I buy the iPhone 15?
Yeah, it's not only because of the tension, also because of why should I buy the new iPhone again and again every single year, and it's look really almost the same, but the chip is slightly faster. So users are asking some kind of question like this. So the recent pullback is not only driven by the news that Chinese officials will not be allowed to bring their iPhone back to the office.
But for Apple, it could be significant, couldn't it? Because if there is a big downturn in sales, maybe because of this Huawei Mate 60 Pro that everyone's talking about, it's sold out on the mainland. But nevertheless, Apple makes about a fifth of its revenues from the Chinese market, so it could be a significant issue, couldn't it? And also, in particular, this issue of what's going on with the Mate 60 and whether that's going to attract more sanctions, or on SMIC, which appears to make the chip for it.
Well, in the longer term, yes, China or Chinese company, they may be able to make like a faster chip for even some of the private sector, and even for some of the cell phone manufacturer. But at the moment, I do really believe that the iPhone, the Apple incident happening in mainland now, it's only a rumor, and also they may ban some of the, as I said, the officials to bring iPhone back to the office. They may do so, but not the consumer, and definitely they will not ban iPhone at all in mainland. So the situation is getting worse, but not as worse as people think right now.
Alex, how do you see the situation with Apple, and what does it mean for Apple? 20% of its revenues, almost 20%, come from mainland China.
Yeah, I think, of course, this is would cast some doubt on Apple's China future, but that is also limited to the government officials in China, so that is not 20% of the revenues. We are talking about probably much less than 20%, probably 1 or 2% only, so at the most. So I think people are over worried about the development, but of course I think this will not be positive. So we probably may see some cap in the Apple share price for a while, but I don't think Apple would have much downside.
I presume that the Chinese government isn't going to want to ruin Apple, because Apple's a big employer on the mainland, isn't it? It employs a lot of local people, has a lot of factories there. So it's not in China's interests to damage Apple too much as it may be tempted to in this tech war.
Oh, in this issue, actually, I doubt, because education actually is also another sector which employs a lot of people. So we see the damage to the education 2 years ago. So I don't know that. Yeah.
Yep. But what do you make of this Huawei phone? I mean, this is interesting, isn't it? Because it seems like it's sort of avoided anything to do with sanctions, because this is a Chinese company dealing with another Chinese company, i.e. SMIC. Presumably this is nothing to do with US sanctions. It doesn't rely on Western parts. It doesn't rely on Taiwan or South Korea or Japan. Nothing to do with patents. They seem to have found a way to get around the damage of these sanctions.
Yeah, so that would invite more sanctions, I think. So, because people look at the capability, so they know that if you don't get more serious on the sanctions, probably they would have a much faster development than you think. So I think the problem is that this is inviting more sanctions right now.
Dickie, let me ask you about the economic data we had out of the mainland. First of all, over the weekend, we had the inflation figures. Looks like China is creeping out of inflation. Consumer prices rose 0.1% year on year. On the core inflation side, that climbed 0.8%, and then producer price inflation dropped 3%, so still in deflation, but nevertheless much slower than the previous month. It was 4.4% the previous month. Do you think the government's right? It's always maintained, there's no deflation in China. The figures seem to be backing that up, don't they?
Well, at least it's likely the deflationary pressure in mainland China. It's a good thing after all. obviously, no deflationary pressure always not welcome. But in the longer term, I think Chinese government, they have to do more stimulus, as I've just mentioned, not only monetary policy, but also fiscal policy all around it. Not only the property sector, but everywhere else, including the manufacturing sector, and also at least another fresh round of triple R cut for the renminbi, triple R cut in the future. But as we can see, the deflationary pressure eased, and I will think that the Chinese, PBOC will definitely have, and they will have another round cuts of reserve requirement ratio. But as long as the deflationary pressure eased, they will not do this at the moment or within this month. They may have another cut in the fourth quarter, but not right now, because they can wait and see at the moment, because CPI actually the data come in much better than people's expectation. So this may also help to stabilize the overall depreciation of the renminbi as well. But as I've just said, I don't really see so much upside or a really strong rebound, but at least this data, it will give some kind of a really short-lived rebound of the renminbi, and also may stabilize a bit the Asia market sentiment.
Why do you think it is that all this stimulus, it's very piecemeal, isn't it? It's coming in drips and drabs, and it seems to be very hard to get Beijing to do very much, despite all the talk about wanting to support the economy, and despite having, Premier Li Jiang, who everyone thinks is business friendly. It seems to be very hard to get the government to really do anything.
Well, yes, you may say so, because you cannot really do something that really can help to boost the market sentiment. When I say market, I mean the stock market as well as the property market. But they already did all rounds of fresh cuts of every single rates in mainland and so on. So wait and see. Maybe the market sentiment, especially the property, will stabilize a bit. Because this is really a key thing. When the property market stabilize, it also gives some kind of confidence for the mainlander to spend on not only the groceries, but also on some of the luxuries items. So wait and see. But nothing can really improve the situation right away.
Alex, what do you make of that inflation data? I mean, it shows that the country is creeping slowly out of deflation, doesn't it? But hardly suggesting strong demand.
Yeah, I think there's still one piece of data, so we need to see continual improvement in that area. Actually, China is not too bad in consumption. If you look at the box office of movies, actually, they are doing extremely well in this summer. So I think people do spend on certain things. So that's why I think inflation data come in better than expected. But I think PPI probably would remain bad for a while, and that need consolidation within the industrial sectors, and that will take time. And overall, I think the global economy probably will slow, so PPI probably will still remain bad. And CPI, I think that will not have too much upside as well, even though we do see some strong performance in certain sectors like cinemas or restaurants or travels. But I don't think we would see across-the-board recovery. And also, I think asset actually will still be deflating. People probably may not have too much interest in buying property, because right now you are still probably limited to the buying interest into those first-time buyer or marginal buyers, but they are very skeptical, and they, if they think the market is going nowhere, actually they would delay their buying decisions. So right now you are only selling those prime assets of the portfolios of those troubled developers. So I don't think we will see recovery in those second-tier or third-tier cities. So very likely we would see asset deflation expectations still there. So I think overall the situation may not help much, and we need to see more data to confirm China is creeping out of deflation.
And what about the trade data? We had trade data at the end of last week. Exports were down 8.8%, imports down 7.3%. I suppose the good news is that it was sort of in line with expectations. The bad news is that trade is still continuing to contract.
Yeah, I think for export, actually, they would still remain bad. First of all, I think global demand actually would slow down, and then we are still facing relocation of activities outside China. So that, I think, would continue to remain bad. And for imports, I think this shows the overall demand actually still not there. Actually, this is some change in consumption behavior in the world, not just China. People are going for experience spending instead of actual goods. So I think that's why we are seeing this kind of trade data. It's because right now people are going for more on experience instead of actual goods.
Dickie, final word to you. What do you make of that trade data? It seems to be showing internal demand on the mainland quite weak, but also external demand. China can't really rely on that either.
I totally agree with Alex. Indeed, most of the teenagers or youngsters in mainland, unlike their parents, they don't have any plan to buy a flat in mainland because they're not getting married very soon, and they may not have a baby. So they will spend every single dollar in cinemas, in restaurant, and in travel as well. So anything that sector related to the restaurant, movie, and also like travel will definitely outperform the overall market.
Okay, well, thank you both very much for your thoughts this morning. You heard there Dickie Wong, who's head of research at Kingston Securities, Alex Wong, who's director of Alex K.Y. Wong Asset Management. I'm joined now by Dr. Yanan Wu, who is chairman and CEO of Surfin Group, headquartered in Singapore. Morning, Yanan.
Morning, Peter. How are you?
Yeah, I'm good, thank you. Let's start with the Chinese economy. We had, first of all, some inflation data over the weekend. China's consumer prices climbed by 0.1% year on year after a 0.3% drop a month earlier, although producer prices, they're still in deflation. They fell 3% year on year in August after a 4.4% decline the previous month. Well, what's this telling us, Yanan, about the state of consumer demand on the mainland?
Yes, Peter, first, hope you find safe in the black storm weather in Hong Kong. Regarding the inflation data, as you just mentioned, actually both PPI and CPI has become positive in the month of August. And actually for PPI, it was the first positive number in the year so far. And among the 30 industries, 16 has shown month-on-month positive growth. So that's kind of encouraging. But when you look at the factors driven behind the positive recovery, both PPI and CPI, there's a number of interesting factors we can notice. One is for PPI, the oil price in the global market has also become an important factor behind the PPI. The oil in both New York and London has been around $90 so far per barrel. So that's pushed up the power generation and also other industrial prices going up. And the second factor behind the PPI, of course, is finally, I think the stabilization growth policy has changed the expectation for the demand for the industrial materials domestically. So the destocking has hopefully bottomed up, will become restocking. Especially consider we normally have a golden September and silver October, which is normally the popular season for traditional industry to pick up the demand and restocking throughout the year. So the months of September, October, hopefully will drive further up the industrial prices. And for CPI number, if you look at the factors, mainly the pork price has been the main factor for the CPI become positive. And so if you look at the pork price in October, it has increased monthly amounts over 11%, and actually that's the largest jump so far this year. So if you look, we projecting September, maybe the supply for pork will become more ample than previous months in summer. So maybe the momentum of pork price jumping will gradually slow down in the coming months.
It does look like, if you look into the data, consumers are spending. They're certainly spending on things like cinemas, or going out to restaurants, on travelling. They may not be buying the goods, but they're certainly spending on the services, aren't they?
Yeah. Yes, indeed. The summertime, of course, is also the off-school season. So a lot of family bring the kids to the for tourists, especially people cannot and probably not willing to go abroad out of China. So the domestic travel season is very, very hot in the summertime so far. This year, finally after 3 years, the family can bring the kids, out of home and go to enjoy some, summertime and enjoy the natural landscape. So the summertime traveling price in August had also shown a positive growth, 1.4%. That's above the average. Above the historical average, so that's a good sign. Especially, airfare and the hotel price all come up than the normal season. So that's indeed show the demand. But the average travel tourist spending still reasonably lower than prior to COVID season. So I think that people's consumption behavior is more rational and still have not recovered back to the previous COVID level. Yeah.
And we also had, as well as inflation data, we had trade data as well at the end of last week. Exports down 8.8% year on year, imports down 7.3% year on year. What's that telling us about the Chinese economy?
Yeah, both exports and imports, the gap of the decreasing has narrowed. If you compare the August number, minus 8.8% in US dollar term, compared to the July was, minus 14.45%. And import number in US dollar term, minus 7.3%, and much lower than the previous July months of minus 12.4%. So indeed, the gap of the downward trend for both export and imports have decreased. Of course, that's also related to the lower base number of previous year. If you look at the structure of the imports and exports, still need to be raise some concern because the largest import from outside globally is from Russia. So in August, the China's import from Russia has broke a historical record, which reaches about 11.5 billion US dollars, and that's another quarter of increase compared to July. And of course, the exports from China to Russia and also reach a high level and close to the historical level that was broken in June. However, if you can see the China's weight in U.S. Import-export has decreased to the lowest level since 2005. And on the other hand, the Mexico and Vietnam has beneficially enjoy the dividend that the China has to do export to those countries, and the foreign direct investment in those countries has also picked up. For example, in July so far, for the last 12 months, Mexicans' weight in the U.S. import-export has increased to 15%, and that's a 30-year historical high. So,
the problems between US and China on trade and the shifting of supply chains all seems to be getting worse, doesn't it? We had the news last week that the Chinese government is cracking down on iPhone usage by employees in government departments. Reports suggest that could be extended to state-owned companies. It's wiped $200 billion off of Apple's market value last week. How big an issue is this? Is China trying to damage Apple at all, or what do you think is the reasoning behind this?
Yeah, the trade definitely is. We can see the decoupling from, like you just mentioned, from the home hardware, home device, smartphone device as well. At least right now, so far, the iPhone ban is restricted at the government level. All these SOEs and government employees was restricted to not use iPhone, but actually focus on the Huawei and the other domestic phone brands. So that's trying to reduce the worry and also the speculation of the data leakage and the GPS location of throughout through the smartphone. So definitely that's a sign, probably further decoupling in other electronic equipments in trade. So we have to watch and see. For domestic market, iPhone still push up its growth and sales in the China, but at least from the capital market point of view, we have seen the related supply chain for iPhone. The stock price has decreased quite a bit, and reacting to this news last 2 weeks, and globally, Apple price also stumbled as well. I worry about the trade imbalance. It has the RMB seeing edge, the offshore U.S. dollar versus Chinese RMB has reached close to 7.4. So it's going to be 7.5, and that's probably a test of psychology level where the PBOC will tolerate for this depreciation trend of RMB.
Okay. Now let me ask you finally about the G20 summit over the weekend. Took place in New Delhi in India. It appears to have been quite a big triumph for India, really, doesn't it? They got against all the odds, an agreement on a final communique, although Ukraine wasn't very happy about it. But it clearly shows that Indian diplomacy, certainly before this conference and during it, has delivered results.
Yes, at least from the preparation for G20 summit, I think a lot of signs has already surfaced up. India has taken advantage of being the host G20 this year, and want to push its own personal agenda as well. For example, India trying to change a new country name, Bharat. Using this platform to try to raise its national pride and brand name, historical importance. And U.S., of course, trying to push for this message against Russia and also win the support for Ukraine. So that's I think probably partly why the China didn't have Mr. President Xi going to attend the summit, but rather the Prime Minister Li Qiang going to attend the summit. In addition to G20, President Biden also visiting Vietnam right after G20 and trying to raise the bilateral relationship to a more comprehensive, a strategic partnership between Vietnam and the U.S. So all these kind of signs are showing the G20, become more and more decoupling as well, become maybe two sides of value system and also political agenda between the two camps. So I think whether the G20 will continue to show such a comprehensive and a cooperation level in the future years, we have to remain to be seen. So it will be interesting to see how they communicate and the unified statement coming out from G20. That's a test whether the G20 summit can still hold it together for the later years. Yeah.
It'll be interesting to see. Also interesting to see how the relationship between India and China develops as well. Yanan, always a pleasure to talk to you. Thank you very much indeed. That's Yanan Wu, who is Chairman and CEO of Surfin Group, headquartered in Singapore.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves on my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back tomorrow with another show. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Christopher Lee, Partner at Farron Augustine and Alexander Investments, and our US economics correspondent, writer and broadcaster Barry Wood. Bye for now.
Money Talk